Hey, hey guys. Sorry, I just took a big swig of water and then just thought I'd wait that out a little bit. Welcome to the show. It's Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an absolutely wonderfully cool, with zero humidity, Redmond, Washington. I tell you what, I had a fantastic trip to New England last week. Got back yesterday evening, which was awesome. So good to see my family. Work from home today, which was great. New England was awesome. Boston was fun. What an amazing city. We lived there for about 9 years, a little while ago, a couple years ago, and awesome to be back and explore a little bit. Then I was up in, sort of southern New Hampshire, southwest New Hampshire. Beautiful area, absolutely lovely natural beauty, wonderful people. Kind of hot and humid this time of year. I would say humid and buggy were two, downsides, but to an otherwise absolutely stunning place. And I was telling people how the Seattle area is kind of this hot, but zero humidity. And I, walked out this morning out into the yard, and it was just it's very chill. So happy to be back here wherever you're at. I hope you're staying cool and enjoying a somewhat of an exciting day in the markets. As you'll see when we get to the market recap, through most of the day actually seemed like a pretty decent update, with the S&P pushing above 6330, but the last hour and a half of trading pretty rough, with the S&P almost getting below 6300 into the close. He ended up S&P was slightly positive, but as we look at the breadth readings, you'll see it was not great. So we continue to have this issue where the market uptrend is still in play. Our market trend model is still bullish. Stocks are still generally trending higher. We're starting to see, again, seeing some challenging signals in there in terms of breadth, in terms of momentum, which makes me think, all right, what's the catalyst that pushes us lower? I would guess, like if you ask me in this sort of, in this particular period, what are the catalysts that kind of, make the market go lower in this environment? I mean, probably earnings, right? I mean, the earnings are kind of the thing right now. We're going to have economic data. We're going to have other things. We're certainly going to have news flow, policy decisions that will impact the market. But I think this week is big time about earnings. Two of the Magnificent Seven names reporting this week: Alphabet and Tesla. The first Mag 7 name that reported last week was Netflix. It didn't go great. Now, today, not a bad candle pattern, which we'll highlight here in a moment. With that as a long-winded introduction, let's get to the markets and how they played out through the course of the day today. Here is the S&P 500 and the other major U.S. indexes. This is what I was talking about today. Here's Friday. Here's the open. So the first 30 minutes of trading, lights out bullish. The next, couple hours, 4 or 5 hours, kind of choppy sideways, and then the last hour and a half just sort of falling off the cliff and rotating lower. So the S&P did finish in the green, but only slightly. We closed at 63.05 earlier in the day. The S&P did hit 63.35. That's where we finished. And NASDAQ Composite a little better today. The Dow actually ended up in the red after selling off through the course of the afternoon. Mid caps and small caps all down. The S&P 600 small cap index down about 0.25%. And by the way, I had a great conversation with my son. I almost brought him on camera here to talk about it, but we were looking at this chart, which is kind of the main market recap page on Koifin, which is another platform that I use pretty often during the trading day. He kind of wandered in this afternoon. I usually, just leave the door open in case he wants to poke in. And this is my subtle way of just planting the seeds about being a technical analyst down the road, probably. And so he starts looking at this and he was like, oh yeah, what's the yellow one? I'm like, well, that's small caps. Those are smaller companies. Like, wow, they really they were up earlier in the day, but then they really rolled over to the close. I'm like, that's exactly what we're going to talk about on the show today. So there you go. Henry with some initial fantastic insights on the performance of small caps today. So small caps, mid caps, not as good as large caps generally here in the U.S. Not a big down day by any stretch. Volatility did tick slightly higher, though it wasn't a big, warning sign day or anything like that. The VIX ends just above, we'll call it 1660 or so. So VIX still below 20, tells you low volatility environment, uptrend still in good shape. What you're looking for here as a red flag would be the VIX spiking above 20. That's sort of the, I have a standing alert for any time the VIX spikes above 20. Just reminds me, okay, Volatility is now increasing to the degree that usually happens during pullback phases. Let's look at some key levels and make sure we're focusing on some potential downside protection. So no red flag just yet in terms of the volatility. Bond markets rallied today. So you can see the TLT was up, not a ton, 0.9%. It was up a little more in the sort of the middle of the day. So bonds and stocks actually had a very similar trajectory, right? Gapping higher, trading higher, but then, trading lower through the course of the day. So that does move rates lower. So the 10-year yield finished around 437. The long bond yield is now back below 5%. We finished right around 5% on Friday's session. The 5-year point right around 3.9%. So stocks basically flat for the day, bonds slightly higher. Dollar index down about a 0.2% drop for the dollar ETF that we track. So not a big movement day. I mean, certainly the sell-off into the close isn't great. As we have mentioned many times, right? When you think about the sort of normal trajectory of the day, the trading day kind of has three general parts in the equity markets. You've got the first 30 minutes, which is sort of the open, and then that initial reaction to overnight pre-market after hours news. It tends to be dominated by retail volume there. Then you kind of have the middle of the day from around 10 a.m. to 3 p.m. Now, again, there's some subtleties in there, but generally that's sort of where there's a lot less volume, and it's more just sort of, any news events that would come out would certainly impact things, but it's usually more of a quieter period than the last hour, and certainly the last 30 minutes is when there's a lot more volume. So there's a lot of trading into the close. That's when a lot of institutions would wait to put in big orders. And so that last hour and looking at what happens there can be helpful, because that gives you as much information as you kind of can get as an individual investor as to where, what big institutions are probably doing. And again, you have to make a lot of assumptions by drawing conclusions there from price action and from volume readings, but it's the best information you have. And so, days like today, hanging in there, pretty good up day, and then the last hour, big rollover. Not great. I mean, that's not ideal, right? A more bullish environment would be, rallies into the close are usually pretty strong there. Now, having said that, where you did see a lot of strength today, precious metals, gold and silver, both moving higher. Copper, it's more of an industrial metal, moving higher as well. I think I grabbed a silver something. I forget what. I don't think it was the SLV, but it was something silver related. I feel like that I grabbed earlier in the day and popped it on the list to review with you. But both gold and silver having a pretty nice upswing. So in the afternoon, while stocks started to roll over, you can immediately see gold start to rallying higher. So really kind of gives a sort of a risk-off feel, at least to the last couple hours of trading. We'll see what happens through the course of this week, of course, for sure. Natural gas getting dinged very, very big, down over 7%. Crude oil prices were slightly lower. The energy sector ended up being the worst performer out of the 11. Bitcoin is sort of toying around with all-time highs. It was sort of above 120,000 on Sunday. Today, strength in the morning Eastern time, but in the afternoon, kind of rolling over along with stocks going into the equity market close. As we are live here after 5 p.m. Eastern, Bitcoin currently just above 117,000. Ethereum prices right around 37.50. All right, looking at the 11 S&P sectors, pretty split, to be honest with you, between sectors up and down. Communication services, the best performer, up 1.33%. Materials and consumer discretionary both finished higher, about 0.5%. On the downside, 5 of the S&P sectors finished in the red. Energy, the worst performer, down just over 1%. And that drop in natural gas prices is a challenge there because those infrastructure names like pipelines and others have been, strong charts in 2025, and certainly compared to the rest of energy, pretty decent outperformers versus the rest of the energy sector. But prices dropping as they are, not helping things today. Healthcare, the XLV and industrials both down about 0.5% today. All right, looking at the breadth, no, not good. On the New York Stock Exchange, not horrible, though. Sort of more neutral, 52% stocks down on the New York Stock Exchange, 45% up. NASDAQ Composite actually slightly more gainers than losers. But the S&P 500 is breadth is where you see the real red color here, about a 2-to-1 ratio of stocks down versus up. So that's a deterioration. Our market trend model, no change as of Friday's close. And as we've mentioned a number of times in recent weeks, in this kind of environment where we've had the rally off the April low, we've had really nice uptrends in a lot of the equity space. I mean, I haven't struggled to find compelling charts, recently in the equity space. Our trend models are going to be all bullish, right? Because that's not, these aren't predictive models. These are telling you the trend. They're defining the trend over certain periods of time, and the idea is that tends to be a pretty good gauge because trends persist, and when the trend changes, the model changes, and that's why it's something you want to not miss, you want to not ignore. For now, it's bullish on all time frames for all the major U.S. indexes. So what you're looking for is short-term weakness. What you're looking for are those initial rollovers that would cause the short-term model to turn negative. And again, we just haven't seen that yet through last Friday. Still pretty constructive. I mentioned I'll look at silver price. I just want to mention gold miners and mining stocks are the top performing Dow industry groups, up about a 3.5% for the Dow industry groups, tracking those particular names. All right, looking at the Magnificent Seven and Friends, the leading growth stocks, you can see Alphabet up 2.7%. That's going into their earnings report coming up later this week. I think that's Wednesday or Thursday. I have the chart. I think I have the chart, but I have an entire analytical panel right here. Why don't I look it up here? They report earnings. Let's bring it up here. All right, the stock charts tells us they report on Wednesday, on the 23rd. I'm pretty sure Tesla's the same day there, right? So two key charts to watch, and as we talked about with our market misbehavior premium members over the weekend, I mean, key earnings to watch. There are a bunch of earnings coming out there. A bunch of the S&P 500 names are reporting this week. It's a lot of technology, a lot of a number of different sectors, home builders, airlines, or a number of things that are represented this week. So certainly this is the time to be focusing on the earnings calendar and paying attention to key names that are reporting on certain days. That's going to be the market here for sure. So Alphabet, nice rally today, heading into our earnings this week, 2.7% to the upside. Netflix up 2% today. This is after dropping, I think it was around 5% on Friday. So a nice counter trend rally. I did grab that chart to show you here in a minute. Broadcom was up as well. On the downside, Nvidia down 0.6%, Tesla down about 0.33%. Not horrible, right? I mean, so overall, these names are holding in there pretty well. I think these are, I mean, usually the most important charts to watch in the equity space, but especially now as we start to get earnings releases, because this is when, the names are so meaningful. This is when there can be big, significant moves. By the way, quick public service announcement on stock charts. If you put names like this on a chart list, you can add columns here, and other platforms have capabilities like this potentially. I don't, depending on what platform you use, I would look for these kind of things. Stock charts allows you to add their earnings dates, and I think that's super helpful because you can basically sort this list by their next earnings. So you can see with a portfolio, or in this case, the big mega cap leadership names, when are they reporting earnings? You can see it's Alphabet and Tesla this week. And these are estimated earnings because companies kind of, confirm them a lot of times at the last minute. Next week, we've got a whole bunch, 4 reporting next week. Meta, Microsoft, Amazon, Apple, all scheduled to report next week. Man, that's a meaty sandwich of earnings to eat next week. For now, we've got 2 to deal with, Alphabet and Tesla, so we'll keep our eyes peeled on those. All right, let's continue on looking at the market carpet. I do see some comments and questions coming in on YouTube, X, LinkedIn, and Facebook. I appreciate you guys so much. Those of you that are tuning in live, as always, thanks for doing so. The cool thing about tuning in live is I'm watching the chat as we go. So if there are any questions that come up, actually I'm showing charts as we're talking about particular indicators or concepts, drop your questions in wherever you can drop a comment on one of those platforms. I'll keep an eye peeled. At the end of the discussion, I'll grab a question or two to answer. And then we'll save some for our Friday mailbag. We had a really fun Friday mailbag episode on Friday of last week. I think about 5 questions that we answered, but some really, really interesting ones. So I hope you can take some time and review that at your leisure. All right, looking at the heat map, I mean, not great, right? And what's interesting about a day like today, communication services, pretty strong day, right? Look at Alphabet up 2.7%, Meta down one, or excuse me, up 1.25%, Netflix up 2%, T-Mobile up 2.4%, AT&T, Verizon all up. I think Verizon reported earnings today, and they're up 4%. So AT&T kind of moving up along with it, T-Mobile as well. So, I mean, communication services had a really good day, right? And all of the top, 6 or 7 names were up, and so that's what's allowing communication services to be the top performing S&P 500 sector. But if you're looking at the screen, if you literally cover up that communication services sector with your hand and look at everything else, not great, right? If you ignore what happened in communication services and look at kind of everything but, not a great day. And that's from technology. Not that there weren't names like Qualcomm up 2.7%, but just the average move was not particularly good. Financials kind of generally pulled back today. Communication services, some stocks up, but not up a ton. Industrials kind of took a bath with a lot of sort of light red to dark red. Energy in particular dropping a little bit as well. So again, outside of communication services, I would not describe this as a particularly strong day for stocks. And the complexion of the market carpet changed quite a bit from like 1 p.m. Eastern to 4 p.m. Eastern. The market carpet looked a lot more kind of decent this afternoon, and then going into the close, kind of got worse and worse. And that's what happens through the course of a trading day like this. The industrials one is an interesting one to pay attention to. Obviously, earnings are going to impact these stocks as they would with any. But a lot of these names have had really good runs. Like Train Technologies made a new all-time high on Friday, so we're down slightly from Friday's close. These aren't bad charts yet, but you're just seeing a bit of a pullback here. So not a concerning breakdown right on this chart yet. I mean, this is still a very good chart. But what concerns me here on Monday, July 21st, not that you asked, but I'm assuming in your head you're thinking, what does Dave think about all of these charts that we're showing? Charts like Trade Technologies are concerning because of the divergence, right? I have a thing called the market top checklist. I usually dust this off anytime there's been a big potential run. I start to think, all right, this is kind of where you'd probably start to see a potential top. I have this in my mind right now, given the fact that seasonally speaking, we're going into, the weakest part of the year here in the next couple months. So what does that top look like? One of the items on the market top checklist is a proliferation of divergences, right? Mostly momentum divergences, because in a healthy bull market, you have prices going higher on stronger momentum. When we get to the end, when we get to like inning 8 or 9 in the uptrend phase, we see prices going higher still, but on weaker momentum, right? So higher prices on higher momentum, that's good. Higher prices on weaker momentum, it's less good, right? And again, that doesn't guarantee a peak, but it often happens at a major top. Just on the chart of Train Technologies here, I'll show you what I mean. Here we have, October, November of last year, higher prices, weaker momentum. You see how we're overbought in October at the peak there. We make new highs, and we're on weaker momentum. By the way, note the what's called a gravestone doji. Remember that, because that's going to come back in a minute when we look at the chart of the S&P 500 today. There's a little foreshadowing, but higher highs on weaker momentum. And if you look, you could argue we're kind of doing a similar thing right about now. And Train Technologies is not the only name with this particular issue. Now, we did see some of that. Train Technologies did not have that as much like in May, but like May, June, some stocks had that. Market was resilient, kind of resolved itself to the upside as it kept showing strength. But this is something that's concerning me here on a number of names, or stocks moving higher on weaker momentum. I'm going to save this, by the way, to the show's charts, just so I can remember what I talked about, because my memory, not ideal. All right, let's continue on now and look at the market recap. I see some more questions coming in. I appreciate them. Keep them coming. We'll grab a question or two at the end of the episode. All right, do you remember the chart pattern, the candle pattern that I mentioned about 40 seconds ago? Gravestone doji. A doji candle is when the open and close are right around the same level, right? So you have the open, we kind of trade around, and then the close. And if the open and close are at the same level, the candle or the bar on the chart looks kind of like a cross, right? Because you have the range, the high-low range but the open and close are identical. So it looks kind of like a little cross on the chart. Now, if the open and close are at the top of the candle, that's called the dragonfly doji. And Japanese candlesticks have great illustrative names. I mean, the names are fantastic, kind of great, visual representations of what the price is doing. So kind of looks like a dragonfly, like with the top and the lower body. If the open and close are at the lows and you have the long upper shadow, that's called a gravestone doji, right? Looks kind of like a gravestone. And that, unfortunately, is what we had on the S&P 500 today. It's kind of like a shooting star candle if the shooting star doesn't have much of a body because the open and close are identical. That is a long-winded way of saying that's not bullish, particularly when you have a gravestone doji. It's about as negative as it sounds. So again, what I'm seeing on the chart of the S&P is just what we talked about with ticker TT. I'm seeing higher highs, and I'm noting some weaker momentum readings, right? And that's just not ideal, right? Ideally, if everything's good, the market moves higher on stronger momentum. That's what you want to see in a healthy bull market phase. That's what we saw like back here, right? Look at the August 24 high, the September 24 high, the October 24 high. And then you can see that, and then you can see that here. And then you can see the opposite here is what I mean, right? Higher highs in price on weaker momentum. We'll see if that continues, right? We talk about that divergence here. It was negated. And the way that you negate a bearish divergence is the market moves higher on stronger momentum. It's kind of like a stop to a short position, right? It tells you we might be topping out, but then you get the signal that it's that it's an all clear signal that we're going higher. We got that in late June on that gap higher. We're seeing that pattern again with divergences here in July, which again, we've often seen sell-offs into August, September, which is why it feels like it's fitting into the seasonal pattern here pretty well. From a trend following perspective, though, the S&P is strong, right? Our market trend model is bullish on all time frames. That's why I have a lot of exposure to stocks, and I'm not changing that. For me, divergences like this are an early warning system. That tells me to start looking for signs of a breakdown. And if I see enough signs of a breakdown, then you take action. So that's what I'm seeing right about now. Trend is positive, encouraging movement higher. Seeing some weaker momentum readings, which suggest we're maybe near the later stages, but no real breakdowns that would cause me to get super negative here at this particular point. All right, let's talk about some other readings, right? In terms of other divergences here, we're seeing the S&P moved higher. The breadth readings are still okay, right? And actually, the long-term breadth readings are still good. So we still have well over 50% of S&P 500 members above the 200-day moving average. That's bullish. The percent of stocks above the 50-day moving average, though, definitely diverging, right? Look how we have higher highs in July. This indicator is moving lower. So think about what that means, right? The index is moving higher, which means at least the important stocks that drive the index are going upwards. But this indicator sloping downwards tells you about 20% of the S&P have actually broken their 50-day in the month of July. And that's just not ideal, right? Ideally, you see the market moving higher. You see a lot of stocks holding their moving averages because they're going up as well. This is something to watch for. And again, it's an early warning. It's not a bearish sign yet. Bearish signs on this really are we go below 50%. But overall, certainly something a chart we'll be watching here. Silver stocks and silver itself moving higher. We've highlighted the strength in gold and silver. These are areas of the market that I have plenty of exposure to. I don't have silver particularly, but I have plenty of gold here. And the SLV making a new 52-week high today, pushing above $35 a share for just the second time. The first time was about a week and a half ago. You can see the momentum is okay. You can see the relative strength is looking pretty good because silver is breaking out and doing so in a stronger fashion than the S&P 500. This is one of those charts where I'm immediately drawn to what I call the moving averages in the proper order. Price above the 21-day EMA, 21-day above the 50-day, 50-day above the 200-day, all as well, right? This is a chart in an uptrend, onward and ever upward, as we say, until that changes, right? So what do you look for as a change? Look for silver breaking below the 21-day EMA. Until that happens, this is a good chart showing plenty of strength. So I would say overall, nice configuration. Most recently, we pulled back to the 21-day EMA in late June, sort of pushed now higher and rotating above. All right, let's talk about some individual names that are top of mind. Alphabet, of course, reporting earnings this week. on Wednesday as we covered. Key moment, I would say, from a technical perspective, this is a strong chart. I mean, it's a great chart, right? And I think a number of things have happened in the month of July to confirm that this chart is in a position of strength. Most importantly, we've broken above kind of this 182 level, we'll call it. That's a Fibonacci level, right? Take the February peak and the April low. If you look at the Fibonacci retracements, the 61.8% level was reached in June. It was tested again in late June, finally broke out about a week ago, and we've continued higher. So that's an uptrend, breaking above resistance, breaking out above previous swing highs and Fibonacci retracements. To me, from a technical perspective, that's saying a retest of the highs is pretty much in play. If, however, we would break below 182, break below that breakout level with earnings this week, that would be a big red flag for Alphabet. For me, would kind of get, stop me out of the bullish thesis, I would say, overall. All right, quiz time. How many of you know this candle pattern? This is a 2-candle pattern. You can see it illustrated here on the chart of Netflix today. You have a big down day followed by a big up day, and this is crucial. Day 2, the up day, does not get above day 1's open, which would actually make it a different pattern, but it gets at least 50% of the way through that first big down day. So big down day followed by a big up day, we get at least 50% of the way through the range of that first candle. Do you know what candle pattern this is? And I will tell you, this is one of those. For me, there are literally hundreds of different candle patterns with a ton of different names. Many of them I don't think are particularly worth following that closely, just because they're not super common, and they, it's just not as meaningful. It's certainly not a lot of people are familiar with them, but this is one that a lot of people recognize because it kind of pops up here. Larry on YouTube, separating lines. That's not it, but it's close. I think you are thinking of this. You're not far off, but that's not it. So 2 candles, big down day, big up day. The answer is bullish piercing line, right? A piercing line candle. So if this would go all the way above day 1's open, that would be called a bullish engulfing pattern. That's a really classic reversal pattern where you have a down day and an up day. Day 1's body from open to close is engulfed by day 2's body. Here, we don't get all the way above there, but we do get at least 50% of the way through. It's called a bullish piercing line candle. By the way, if you flip that over, it's called the dark cloud cover candle, which I randomly have peppered in. Like, this is an example of that, right? Big up day, big down day. We don't get all the way below day 1's close or open, but we do get at least 50% of the way through that first candle. That's called a dark cloud cover pattern. This is called a bullish piercing line. I'm pointing it out here on the chart of Netflix because it's happening right as we are testing the 50-day moving average. So a down day on Friday post earnings. They reported earnings after the day on Thursday. Stock gapped lower on Friday, down about 5%. Today, lower open but higher close, and that bullish piercing line candle happens right at the 50-day moving average. That's a bullish candle, telling you the next 1 to 3 bars more likely higher. Now, remember what Steve Nissen, who really is credited with introducing the West to Japanese candlesticks a number of years ago, and wrote a number of really awesome books on the topic. He had told me years ago, he uses on a 2-bar pattern like that, use the low of the 2 candle pattern as the stop, right? So you're kind of long here at the close with that as your stop. So that's how I tend to think of it. But short-term bullish for Netflix after Friday's drop, which I think is pretty powerful. All right, I kind of hinted at what this one would be. This is the uranium ETF, ticker UR. I think I did URA. Yeah, URA. And I don't own this uranium ETF, but I do own that other one. It's like NLF or one of those. It's so many tickers out there. Something like that. There's a different nuclear ETF that I do own in mine, but it's not URA. It's like NLF or something, but that's not it. But it's something like that. But anyways, both of them are featuring this 2-candle pattern. This is a bearish engulfing pattern, right? So up day, down day, day 2 engulfing day 1's body. If you're not big on the candle patterns, but you do look at bar charts, you call this a bearish outside day, right? So an outside day, meaning the range has expanded, you had an up day and then a down day. So wider range and a down day is a reversal. So that's suggesting the next 1 to 3 bars for uranium stocks lower. So uranium stocks had a big reversal day today. I'm also noting on the charts of this, and I'm not changing my position in that ETF. It's more of a long-term holding for me. kind of playing on the ridiculous energy requirements of all this awesome technology that we're now using day to day with, AI and AI bots and AI research tools and all that, many of which I think are fantastic and also somewhat scary. The energy requirements aren't going away, but in the short term, on the tactical time frame, if I'm more of a swing trader, this is where I'd probably be playing it more to the short side, looking for a pullback to the 21-day EMA, because we also have a bearish divergence here as well, right? Higher highs in price, we get the reversal candle as we get the bearish divergence here. So again, these aren't end of the world charts just yet, but these are kind of some, weird, topping signals that I've definitely seen a number of times over the course of my career, and I'm noticing them here today. All right, that nuclear ETF is annoying me that I can't remember the ticker. NLR. I knew NLF wasn't right. NLR. This is the one that I personally own. Full disclosure, almost the same chart. I mean, there's similar ETFs, same idea, but you can see the bearish pattern and the bearish divergence as well. Things to think about there. Some interesting candle reversal patterns here today, and again, those just tell you about the next couple bars. Live Nation, another one where I'm getting these divergences. I didn't mean to turn Monday into divergence day, but I'm just noticing these through the course of the day. Live Nation is still a pretty good chart, right? And we're above all the moving averages. The moving averages are all sloping up. So from a trend following perspective, this is a good chart. In the short term, right, if you zoom in a little bit here on the chart of Live Nation, you can see we've stalled out a little bit, right? And this is around 151 to 152. That's the peak from mid-June, late June, now mid-July. So we've kind of bumped up against resistance. And every time we've tried to make a new high, we're doing it on weaker and weaker momentum. So not breaking down yet. I would say uptrend still fine, but divergences tell me maybe we're near some sort of topping pattern. So what you look for here would be breakdown, right? We look for is a breakdown that validates that this early warning was something to follow. All right, so what looks good if we're seeing all these issues? Train technology. I saved that because we talked about it already. So what looks good? Spotify. Spotify is actually pulling back to a 50-day moving average. One of my premium members asked about this chart over the weekend, so I wanted to just mention it. Chart of Spotify, in my opinion, interesting opportunity for a bounce to the upside. We've sold off here in the month of July, while the S&P and the NASDAQ have gone higher. But take a step back from a technical perspective and look at the structure here. The overall longer-term trend is still good, right? Because we're still making higher highs and even higher lows. We've pulled back to an ascending 50-day moving average. And as we've covered many times on the show, that's often where you get a pretty buyable dip. Now, what you look for on those buyable dips is for the RSI to hold 40. That's always usually a pretty good sign that the momentum is still strong enough that we can make a move higher. It's kind of where we're at. We've pulled back to an ascending 50-day moving average. The RSI currently still holding above 40. I would even think of downside risk to like 666, which is the 38.2% retracement of the April low to the late June high. So it's kind of the general buy point I would have in mind. If I like the company fundamentally and I'm looking for buyable dips, this is kind of where a buyable dip would be. Now, what you do or how I would approach this if I was pulling the trigger on a trade like this, you buy here on the pullback, you use the stop to limit the downside risk, right? So you sort of long with the stop below 666. That's how I would generally structure the trade. You look for a breakdown there and or a break below RSI of 40. That would tell you it's not a buyable dip. It's more of a larger decline. Now we've defined our downside, risk, but we've also playing an opportunity to retest the previous high. So Spotify could be setting up as a pretty interesting setup. I'm getting some nice comments about candle patterns. That just kind of happens randomly, but I appreciate the feedback. I'll do it more. I've had a number of questions on swing trading, and for me, candlestick charts are just one of the greatest swing trading tools, because it's really about identifying short-term changes in sentiment, right? From accumulation to distribution or distribution to accumulation. And regardless of what the longer-term trend is, those candle patterns can give you great short-term swings that I found so valuable. So I appreciate the feedback, and we'll definitely do it. All right. What other random questions can we get here? MJL, thanks for watching on YouTube. Bullish cup with handle on the monthly chart of XLRE. That's the real estate ETF. We'll take a look at this and see what I think you're talking about. This right here, cup with handle. So I'm going to look at the weekly chart, which actually is probably going to make it a little easier to see. Yeah. So here we go. So you're saying, is this a cup with handle pattern? Let's take a look. So first off, as a reminder, when we're looking at things like real estate, you probably want to take the dividend adjustments off, because what the dividend adjustments do is something like this that pays a decent dividend. Every time an ETF or a stock pays a dividend, the price of the stock goes down, right? So the price of the stock comes down to pay for that dividend that's going out to all the shareholders. And that's how the shareholders are kind of remain whole, because you're just taking some of the stock away and paying it out in cash form. But what happens when you adjust the dividend, you're adjusting all the historical data down a little bit to adjust to the new price level. And that's a common practice called adjusted data. Most charting platforms either do that by default, like stock charts, or do it as an option. Even on Bloomberg, you have the option to adjust or not adjust. And it really is more of a user-to-user decision as to whether or not you want to do it. And this is a source of great debate when I go to like a technical analyst conference and it's cocktail hour. These are the kind of things we debate over a glass of wine. Is, what should we adjust or not? When should we? When shouldn't we? And then no one agrees, but we're all still friends at the end. So in this case, I think it is helpful to unadjust the data, because we just want to look at the price data itself. Now, when you do that, the problem is it's not much of a cup. Now, it looks like a cup and handle on like the monthly chart because we're zooming out so much. And if you don't adjust the data, it looks kind of like a cup and handle, right? And I get what you're asking about. But if you really look at it and look at the weekly data and take the adjustment off, it really doesn't, because the problem is there's too big of a gap between that peak, like the left rim of the cup and the right rim of the cup. They really should be more, more even. So I would not call that a cup and handle pattern, although it's close. And I get why you'd see that. I don't think that's a bad. That's a decent question, because I think that was fair, and it looked like it kind of on the monthly chart. On the weekly chart, I wouldn't call it a cup and handle pattern. Would I call that? I don't know what I would call it. I mean, maybe you'd call this like a bull flag, where you have the rally and the flag, but even that isn't ideal. This is the kind of chart where I actually just go full kind of trend line mode, because trend lines still work, right? I mean, as much as we need to do crazy things, draw a trend line off the lows, and when that's broken, the trend is changed. Draw trend lines off the highs, and when that's broken, the trend has changed. So we're very close to breaking back above the 40-week, which is kind of like the 200-day moving average. We're kind of close to breaking above trend line resistance. I think pretty good, opportunity if we do complete that breakout. But would I call it a cup and handle, which was your question? I probably wouldn't, but I appreciate that so much. All right, I'm bringing up this question just because you're talking flying. You're headed to Oshkosh. Randall, I am so envious, my friend. I have literally never been to Oshkosh, Wisconsin for the show. For those of you that are not private pilots or student pilots, there is this legendary annual sort of event for pilots. It's in Oshkosh, Wisconsin, at this cute little airport. And for that one weekend, it becomes the busiest airspace in the world. When you think about comparing that to like London Heathrow and Atlanta and some of these like really busy airports, that seems ridiculous, but it's absolutely true. And they actually will land multiple airplanes on the same runway, and you have like a dot on different, places on there. So like you land on different thirds of the runway because they have to get so many planes in. The fact that they even do it and get that many planes down without, horrible disasters is an absolute miracle. I have never gone there. Man, it's on my list. I'm not going to be able to do it this time. Boy, someday I will do it at some point. Today is not the day, but I am super envious. I wish you safe flying. As Greg Morris, who is one of my investing technical mentors, but also a flying mentor, would tell me, keep the blue side up. So I hope you're able to do that. But your question about the markets, do you think Fibonacci retracements work better on indexes or individual stocks? Now, that's a decent question. Would it work? But I mean, honestly, I think they work pretty well on either. I don't think I would differentiate one versus the other. I would say, I would tend to think of it as stocks and ETFs, right? And ETFs are basically indexes. I mean, ETFs track indexes. I usually use ETFs as much as possible because the data is pretty consistent. The tickers are consistent, pretty easy to talk to people anywhere, at least in the US and Canada, that sort of traffic in ETFs, and those are pretty familiar tickers to be talking about. And I would say they work pretty well anywhere. Where they do not work, and I would say the challenges for something like Fibonacci retracements would be something where the liquidity isn't high enough, or think about something that's not traded as often enough. So an ETF without enough assets, without enough volume, so the data is more spotty, then Fibonacci retracements aren't as helpful because you have these weird kind of awkward price gaps. So think about like a Pink Sheets or an over-the-counter stock or an ETF that just doesn't have a lot of volume, right? Not a lot of AUM. And so it's not traded often enough to have really good data. And honestly, that's an issue with any technical indicator. I mean, if the data is not consistent enough and the data is not transparent enough, technical indicators aren't as valuable because it's all as good as the data that you provide the model, right? So that's the only issue I would see. But for commonly referred to equities and ETFs, pretty interchangeable. I think it's valid for all of those major indexes. Absolutely, I would use them as well. Some of the great calls I've had, I don't know if there's one that comes to mind, but when I think about in history of my career is using Fibonacci retracements and identifying when pullbacks could end up, ending and ending up, where we might find some key support and resistance levels. That'll do it for today, guys. Awesome questions. Thank you so much. I didn't get to some of these that were actually really interesting. I'm going to put those in the mailbag if that's okay. Friday's episode, we like to highlight some of the great questions during the week. So please, if you're watching our replay, just put a comment below the YouTube video and drop some questions in there. And I'd love to answer them when time permits. In the meantime, I will say have a fantastic Monday evening. Thanks so much for tuning in. And remember, it's always a good time to own good charts. Have a good night, folks.